What do you think's been behind this recent bout of risk aversion?
I think it's the macro overlay. I think the markets are very much focused on some of the earnings story, but possibly overlooking the weight of economic deceleration that is playing through right now, particularly in the United States. I note the S&P is up some 6, 7, 8% year to date. It's pricing in a soft landing, it's pricing in a pivot, it's pricing in a sharp deceleration in CPI, but really that's not our base case at all. I think it's much more likely that we see some kind of European recession, a couple of quarters of negative growth. I don't think the pivot's going to play through until the first quarter of next year. And it seems that core CPI is proving a lot more sticky than perhaps originally anticipated. So I think that the macro overlay is probably dominating the performance of equities, particularly in China. In our view, China is much more of an onshore story. It's much more of a retail story, driven also by money market funds, mutual funds, and we're seeing evidence of that bid in play. But away from the onshore domestic story, I think the global appetite for equities is diminishing. I'm looking at a whole range of technical signals which seem to be suggesting a risk-off environment. And actually, it's one of the reasons why we, as a house, have been underweight equities now for a number of months, essentially anticipating this more worrisome backdrop into the second half of the year.
It makes me wonder. I mean, last year seemed like everyone talks about, it's not going to look as bad as 2022, where everything was basically coming down. This year, though, I feel like it's more fits and starts, where it becomes much more volatile, where people start to think that things are, rallying and things are looking and turning the corner, and then we have doubts about it, whether it's China, whether it's the Fed, the like here.
Geopolitics, too.
Yeah.
Well, the Fed, I think, has been reasonably consistent in suggesting that it will keep rates higher for longer, but the market's not necessarily bought into that story. The market's always anticipating something of a pivot, and indeed, if you look at Fed fund futures, which I did just before I came out, the market is still hoping for something of a cut in July. In our mind, that's far, far too soon, given where core is right now and this very sticky effect of rising wages on services more broadly.
If they raised rates next week and then they cut them in July, that would look like a policy mistake, so they wouldn't do it, would they? But I want to get a sense of how, you look at the various sectors and bank strain here as well, and some have called it QT cubed with the way that loans are now being judiciously given out, and a lot of the, of course, regional banks under pressure. We've been hearing from First Republic and others as well, as the big ones benefit from what's been going on in those deposit outflows.
Well, absolutely, Rish, and there's probably another dynamic as well at work there, in that in many respects the Fed has been battling against reasonably robust household balance sheets, reasonably robust cash positions amongst corporates, and of course that very low unemployment rate, and they've been raising rates pretty aggressively, if not one of the sharpest tightening cycles I've seen in 20, 30 years. And the interest rates have had yet to have a meaningful effect. I mean, we'll have Q1 GDP, as you suggested, tomorrow. I suspect that we'll see Q1 coming in about 1.9%. That's still pretty high. So the point I wanted to make was that the credit tightening actually will improve the efficacy of the Fed's higher rates. And this is likely to bite a little more meaningfully into the second half of the year. Essentially supercharging, if you will, that deceleration, that tighter monetary policy, and essentially getting unemployment up to a level and inflation down to a level where I think it's consistent with interest rates.